The best operators in the business will never own what they run. Not because they're not good enough, because the capital game has changed and nobody told them about it. They're competing against publicly traded companies who can buy another rooftop with just the profit they made in one day. And they're also competing against family dealer groups that's been there for 3 generations. And those families don't need to raise $1 in order to make a deal. If you're a single store owner trying to get to 2 stores, or you're a general manager who knows deep down that you could operate a store better than the people you're operating your store for, the math doesn't favor you unless you understand how the capital actually moves at this level. Most dealers don't understand it, and that's the gap. I've been in this business for 19 years. I've walked into hundreds of dealerships. I've stood next to some of the sharpest automotive operators in the country. People could run their stores better than the corporate brands that they were operating the store for. And I watch every single one of them tell me the same thing. They could never make enough money in the car business to break out and buy their own store. Not on their best year, not on their best decade. They were locked in, operating someone else's family business for the rest of their career. That's part of why I built Assura Capital, not just to install the F&I systems that we do with Assura Ops, but to get the capital, the structure, and the path to ownership into the hands of the operators to give them the opportunity that they deserve. I'm Jeremy Williams, president of the Assura Group. For the last 5 years, I've been on one specific mission. How do I get acquisition grade capital into the hands of the best operators in the business so they can finally own what they're already running? In the next 12 minutes, I'm gonna walk you through 3 doors that I knocked on. 2 of them were walls dressed up like doors, and the third one is the structure I just used to put a $45 million line of credit into the hands of a dealer who's already selling 225 cars a month. And by the end of this video, you'll know exactly which door to knock on and which 2 to walk past without losing any time. Let's go. Point number 1, the insurance company ceiling. My service contract company will give me what I need to buy the next store. That's not actually true. Not in this market. In this market, they're gonna give you enough money to maybe refinish your existing store, maybe get a new frontage and become factory compliant, but they're just not gonna give you enough money to buy another store. Not if you're a single store operator. When I first started looking for capital to help my dealers acquire, the insurance companies were the obvious first step. They had relationships, they had the capital, and they were already partners in the business. But here's how the math actually worked out. They look at how many cars you're selling per month now. Right there, that excludes anyone that doesn't already have a store. So you operators that are trying to get a store, you're out on this one. They combine those numbers and they ask one question. How many service contracts is this combined operation gonna produce per month? And let's say you ring the bell and the 2 stores together are gonna sell 100 service contracts a month. They take that number and they multiply it by $300 a contract. Sometimes a little less, sometimes a little more. They put that $300 as a repayment pack on all the service contracts. And a lot of these insurance companies, their risk profile, they're willing to stretch that out for 36 months. So a realistic deal on that kind of volume is gonna come back with just over $1 million that the insurance company is gonna forward you in advance. And most service contract providers would do that to help you buy a store. The problem is that $1 million is not even coming close to the down payment or the cash required at closing for a franchise store. Not in today's market where blue sky multiples have gone up, and not when you're competing with the big box stores. The model isn't broken, it's just not designed for what you're trying to do. Don't waste time and opportunities trying to squeeze acquisition capital out of a service contract company. No, they're a great partner for their actual product, but they're not your acquisition partner. Know which door you're knocking on. Point number 2, the family office wall. A wealthy family office is the perfect partner to help me buy dealerships. Family offices, they don't want your deal. Not because there's anything wrong with it, but because it's not big enough to be worth their time. After the insurance company route went to a dead end, I went looking somewhere else, and family offices were next. A family office, just so we're all on the same page, is a very wealthy family that pulled their money out of a big investment firm, and they built their own private investment firm that only exists to grow that family's capital. They usually got a person in the equity department, they've got a person that knows and understands credit, somebody who handles ground up real estate, and they're a real estate development expert, so they know what good investments to find for the family. Sometimes they have an expert in the oil business and they know how to do oil discovery. Rarely will you find a family office who actually understands the retail automotive business and how the capital structure works within it. But the key point here is a family office is just a wealthy family who set up a business that manages their own money, and that family's net worth usually starts with a B. There are a lot of them in this country, and they are always looking for unique alternative investments that aren't competing with the public market. On the surface, a dealership acquisition deal fits that profile. So I started bringing them deals. $5 million, $8 million, $10 million acquisition deals. Every deal came back the same way. This deal looks good on paper, but it's just not big enough for us at this time. Bring us another deal. We want to do a deal with you. After several deals got denied, I finally asked a few of these family offices, what's the bottom line here? What size of deal do you need to get you even to come close to saying yes? And the reality is, if it's not a $25, $40, $50 million deal, they don't even have time to look at it. The deeper truth that most dealers don't understand is that family offices are in the business of protecting their family's money. They don't want to take on too much risk. They don't have to. They're billion-dollar families. What they want are the returns that this world has to offer with as little risk as possible. That's why they're not looking for the person that has one store to try to help them get two. They're looking for that person that has 4, 5, 6, 7, 8 stores or more, and it's a $50 million deal, and they're going to collateralize it with your existing business, and it completely eliminates the risk for the family office. Because if you don't pay and it doesn't work, they're not only going to take the stores you bought, but they're going to take the stores that you've developed over your career. Bottom line is that this strategy just isn't going to work for that person who's trying to buy their first store or has 1 or 2 stores trying to get their second or third store. If you're not bringing them a $25 million plus deal, don't waste your time pitching a family office. Not very many of them know exactly how the car business works, and they won't take the time to learn it long enough to be able to do a deal if it's not at least a $25 million deal. This model just wasn't built for that smaller dealer trying to get another store. Quick break. If you're an owner trying to acquire your next store or an operator that's been told you don't have the runway to own one of your own, reach out to the number on the screen. We'll look at your exact situation. We'll look at your numbers and you'll walk you through whether this structure fits. Not a sales call, a real conversation about whether the door is the right door for you. One more point to go. Let's get to that door that actually opens. Point number 3, the structure that actually works for that car dealer that has one store that's trying to get to their second store, or that operator that might have a minority interest in a store that they're operating, but they want to own their own store one day. If the insurance companies won't lend you enough money to get a store, and the family offices won't touch it because you're too small, where's the capital structure for a single store dealer trying to grow? There is a capital structure. It's not lending in the way you thought about it before. It's not the same sort of guidelines that you get when you go to an SBA bank. This is a publicly traded company that is purpose-built for exactly this type of acquisition. After running into the family office wall, I had to dig deeper. And what I found was a publicly traded company whose entire business model is raising capital for business owners to acquire more businesses. It'll also work for that operator that's trying to get their first store. Here's how it works. They're publicly traded. They're governed by the Securities Exchange Commission. They look at your deal, and if they like it, they will issue you an LOI. If you sign the LOI, then they go to a Wall Street banks. They post their own company stock as collateral to raise capital in the form of debt against their own equity. That gets them the money at a lower interest rate because it's fully secured by their own stock. And they pass that money on to you in the form of a line of credit. Yeah, they charge a few points, and they charge a slightly higher interest rate than what they can acquire capital at. But again, they're taking the risk. They're putting their own stock up so that you qualify to buy a store. The spread between what they can acquire the capital for and what they can sell it to you for is how they become profitable. The reason this works where the other doors don't is they're in the business of underwriting risk and putting deals together. That's their entire business model. They don't get paid if they don't put a deal together. Where the family office, they're sitting on several $billion. They don't have to make a deal today. Where these guys, they want to make a deal today. That's how they earn a living. This company wants to underwrite the risk and get paid for doing it well. The last deal we ran went like this. The car dealer was selling 225 cars a month. We had a long-standing relationship with this client, so we knew him and we trusted his numbers were investment grade and ready to put in front of the investors. We put his financials in front of the investors. They came back to us with a $45 million line of credit. The first version of that LOI was completely unusable. Yes, it's true. It was for $45 million, but the way the company wanted to collateralize it in in the initial LOI made it completely unusable for a car dealer to go buy car dealerships. These people are not from the automotive and have never done a deal in automotive before we did this one. So I had to show them exactly what would work and what would not work in automotive. That way we could build a frame around their system that they've been raising capital for all sorts of other industries all over the world. They've just never done a deal in automotive. So that frame was pretty simple. I know exactly how the deal needs to be collateralized so you could actually use it to buy another store. So you already have, as a franchise dealer, the problem with the way they wanted to collateralize it originally is they wanted to collateralize it with the blue sky value of the business that they're purchasing, the real estate, and the inventory. That doesn't work if you're trying to be a franchise dealer because you already have banks that are going to give you very favorable rates on the real estate and the inventory lines that are far cheaper and far better than anything a line of credit could accomplish for you. The reason why the line of credit exists and why it's going to work for you is because you don't have enough initial capital to bring cash to the table at closing. So their original LOI, you would have lost access to the cheaper flooring lines, you would have lost access to real estate financing, and the franchise system already provides. So we restructured it completely, and we taught this team how to do deals in the automotive space that could actually get somebody to be able to go from no stores to 1, 2 stores to 3, 3 stores to 5, and have those funds actually be usable in the transaction. So we restructured it completely, and here's the final version of what actually works. The dealer sets up a special purpose vehicle, an SPV. Sounds fancy. All it is an LLC. The LLC is going to own the next dealership that's being acquired with the proceeds from the line of credit. The $45 million line of credit is collateralized by the blue sky value of the business owned by that LLC. Hear me again. We're going to collateralize the line of credit by the blue sky value of the business that was purchased by that LLC. So for example, if we go buy a Chevy store, we know that Chevy stores are trading at a 4 times, sometimes a 5 times multiple of EBITDA. If you buy a Chevy store that's doing $1 million a year, the blue sky value of that is $4 to $5 million. So they're going to collateralize their line of credit with the business value of the businesses that we're going to be purchasing. Why is that important? Because they're going to allow some other bank to take first position on the real estate and the inventory. Game changer. Now we can actually go buy dealerships because they're just going to collateralize this thing on the blue sky value of the business. And all that means is that you own 100% of the business. You own 100% of the LLC that was set up. The special purpose vehicle is 100% owned by you, but in the event you default, it's going to be owned by them. So we set these things up and we find a way to deploy the capital to where we can return more profit to the business than the cost of capital. And that's how we grow an automotive group. Because they only collateralize it on the blue sky, that leaves the dealer free to shop the best possible flooring rate and the best possible real estate loan, completely separate from the line of credit. The cash from the line of credit becomes usable for closing. Once you close the deal, you combine the profitability of both stores. If you find another deal that pencils, you go back and you do it again. That's how small dealers with the best operators in the business start building real automotive groups. Not because they were born into it, because they finally understand where the capital lives. If you're going to acquire your next store, get the structure right from day one. Don't let a lender collateralize the assets you're going to need to be financed separately. The SVP and the blue sky collateral separate the flooring line, separate the real estate financing. That's the architecture. Know it before you sit down with anyone. The old identity is the operator who accepts that they will never get to own what they run. The dealer principal who can't get past store 1 because the math just doesn't work. The owner who watches publicly traded chains and 3-generation families keep buying up the rooftops that they could be operating better. The new identity is the operator who knows there's a capital structure built for exactly this situation. This person can walk into an acquisition with confidence because they already have an SPV set up and they know that they've got a line of credit that's going to be collateralized by the business value. They're going to keep their real estate financing separate and their flooring separate. That's a real path to owning more than just one store inside of a single decade. You don't need to be born into the car business. else. You need to know how the capital actually moves at this level. That's the gap that closes everything else. The best operators I know live by 4 words: discipline, precision, integrity, and relentless execution. That's not a slogan. That's a standard a builder holds themselves to before they hold anyone else to it. This channel isn't for the dealer with 15 rooftops and a CFO. It's for that single store owner who knows there's a second store out there. The general manager who knows they could run an entire group if anyone ever let them in the door to ownership. The operator who's been quietly preparing for their next move and just needs to know where the capital actually lives. If that's you, subscribe. Show up every week. We're going to keep walking you through this side of the business until you can see your next acquisition clearly. One question for the comments: if you could buy your next store this year, where would it be? What brand? What market? What rooftop? I want to know what dealers are eyeing. Drop it below. I read every single comment. If you like this video and it made you feel something inside, if it's your turn to get to the next level, maybe you're just an operator of a store right now, but you've known that you could run one of these stores better than the person that owns it, or you're a single point, family owned dealership and you put everything into your business and you know it's your turn to get to 3, 4, 5 stores within the next 10 years, hit subscribe. I post videos like this every single week, and if you want to learn exactly what sort of things you need to think about as far as which departments need to run and how well they need to run before you sit down in front of an investor and have your financials reviewed, then watch this next video. We're going to break it all down.